estate boy, and welcome to this weekly blog that I do or video blog. And today, what we're going to talk about is what to expect from the housing market in 2023. Now, this is going to come from a blog of mine that if you kind of go to, I'll take you guys right now. If you go to www.colinathanarlene.com, okay, let me bring this in fast. So if you go to www.com and you go all down, this says Colin Nathan Alim's blog. So if you go in there, you'll come to my blog page, and this is where I'm getting this from. Okay, so what are we talking about today? We're going to be talking about what's happening, what to expect from the housing market in 2023. So it's been a wild one. The last 5 years has been a wild one in real estate. Okay. Um, Buyers have had a tough time, sellers have had an awesome time. And now we're kind of seeing a changing of the guard. So let's jump into this blog and let's get into it. So the blog first is saying that in 2022, the housing market has been defined by two things: inflation and rapidly rising mortgage rates. And in many ways, it puts the market into a reset position. So there's been in 2022, what's been a headline? Inflations. And then after inflation came, what was the other headline? Rising interest rates. Because here's the thing, the Fed doesn't care about the housing market. What they want to do is they want to get inflation under control. Now, a lot of us, we've been seeing higher inflation rates. I mean, just go to the grocery store or just look at the gas prices. Okay. Inflation means what? That things cost more. So our money is worth less. So, what the Fed wants to do is they want to slow that down. So, the only tool they really have is to rise or raise interest rates. By raising interest rates, you're making it more expensive to borrow, and you want to control, meaning the government, they want to control people's behaviors. So they want to say, hey, listen, stop buying because things are costing too much and you're devaluing the monies or the dollar that we have. I mean, you can just look at eggs. Eggs now, you can those eggs that you used to pass over that was $1 or $1.50, 12 or a dozen white eggs, you would pass those over and go get the brown ones or the organic ones. But now, some places those dozen of eggs cost $5 or $6. So things are just getting more expensive, okay? And the Fed wants to slow that down. So the only tool that they really have is to what? Is to raise the price of borrowing money. Okay? Because a lot of people don't know this, but America is one of the few economies where the economy for the most is based on credit. It's based on credit. If you go out, you see all these large companies and you see all these skyscrapers, these tall buildings. Most all of them are bought on credit. Most of them are bought on credit. What does that mean? I don't have the money right now. Or that means that me as the business, we don't have the money right now. But what we want to do is we're going to borrow it and then put that money in. So, for example, if I'm selling widgets, okay, if I'm selling widgets and I'm using my money, maybe I can sell one widget for $10 and maybe the profit's $5. Okay. But if I have 1,000 widgets, okay, then maybe I can scale. It's called economies of scale. Economies of scale is when you do more of something so it costs you less. And that's what the American economy is based on. The American economy is based on credit. So what happened these last couple of years? It's been super duper cheap to borrow money. It's been super cheap to borrow money. So more people have been borrowing money. More businesses have been borrowing money. So people were, wow, I just got I just got my back tooth pulled. Okay, and I just kind of bit it. So um what's been happening is that businesses have been borrowing money. People have been borrowing money at an alarming rate. And it was all good until it drove prices up, drove prices because it's supply and demand. The demand goes up, okay? If the demand goes up and the supply doesn't go up, then what happens is the prices rise, okay? And that's what we've been seeing. So the blog says, as the Federal Reserve, the Fed, makes moves this year to try to lower inflation, mortgage rates more than doubled, something that's never happened before in a calendar year. So mortgage rates have doubled. And again, that's something that we've never seen. We've never seen mortgage rates double. But in 2022, mortgage rates doubled. Okay. Now, this had a cascading effect on buyer activity, the balance between supply and demand, and ultimately home prices. Now, and as all things change, some buyers and sellers put their plans on hold and decided to wait until the market felt a bit more predictable, right? So interest rates double. What happened to buyer activity? Buyers, okay, home buyers fell off. They say, hey, okay, it keeps going up and up and up and up. And now that $100,000 house that was $500 a month now is $700 a month. So that's what we've been seeing happening here. Okay. And activity has fallen off. I mean, just in Philadelphia, activity is down like a quarter. Okay. A quarter. So home prices haven't dipped that low. Okay. They're off a little bit, but the activity is what we're seeing. We're seeing a big drop off as far as activity in the Philadelphia area. Okay. So going back to the blog, it says, but what does that mean for next year? What everyone really wants is a more stable market in 2023. For that to happen, we'll need to see the Fed bring inflation down even more and keep it there. Here's what housing market experts say can happen next year. So we're going to go into what some of the experts are saying about mortgage rates next year and what the experts are saying about home prices next year. Now, here's the thing, we don't know what's going to happen in the future. Okay. This is a guesstimate. It could be better, it could be worse. So that's why when you look at these projections, I do say take it with a grain of salt. But look at your situation right now. What are you? Are you a buyer or you're a seller? All right. Here's the thing. If you're a buyer, the most important question is what's your time horizon? For buyers, that's the most important question. If you're looking to buy a home, why are you buying it? Are you buying it to live in, or are you buying it for investment purposes? Now, if you're buying it as an investor, are you looking to flip it, or are you looking to buy and hold it? Okay, so let's take the first one. If you're looking to buy a home because you want to live in it, if you're looking to buy a home because you want to live in it, then your time horizon is probably what? 5, 10, 15 years. Listen to me. You can go back in time, any point in time in the housing market history. Go back 5 years, go back 10 years, go back 15 years. Okay. And you'll see that houses in that that 20-year span have gone up. They're going up. So if your time horizon is over 5 years, then yes, you should be looking right now, and it's a good time to buy. Now, if your time span is only a year or two, then yeah, that's speculation. I don't know what's going to happen with the market. I don't know what's going to happen in the next year or 2 or 3 years. So if you're looking to flip, if if you're an investor, and you're looking to flip, then yeah, you may need to kind of see what's going on. Okay. So that's for my buyers. And also with my buyers, if you're looking to invest and you're looking to buy and hold, again, what's your time horizon? If your time horizon is 5 years, 10 years, 15 years, yes, it's still a great time to buy. But if you're a seller, if you're in the Philadelphia market, if you're looking at what sellers having, you're still getting close to those high numbers. Okay. Now, this is not during the COVID. This is not last year or 2 years. So you're not going to get what your neighbor got last year. You're not going to get what your neighbor got in the summer, but you could get close to it. You definitely could get close to it. Okay. So let's 1 second, y'all. Hello, Scarlett. Okay. I don't know why people was calling me. Okay. So next is what's ahead for mortgage rates in 2023. Okay. So moving forward, experts agree it's still going to be all about inflation. All right. If inflation is high, mortgage rates will be as well. But if inflation continues to fall, mortgage rates will likely respond. Where there may be early signs inflation is easing as we round out the year, we're not out the woods yet. Okay, inflation is still something to watch in 2023, and that's something that we're gonna have to keep an eye on from here going out. Okay, it's almost like when a person's fighting. Okay, when you're fighting and you get hit with that left jab, bop. Now, okay, now you're looking for that left jab. Okay. That's the same thing here. Inflation kind of popped us in the eye. So now we're going to be looking at inflation from here going out. Okay. It says right now, experts are factoring all of this into their mortgage rate forecast for next year. And if we average those factors together, experts say we can expect rates to stabilize a bit more in 2023. Now, whether that's between 5.5% and 6.5%, it's hard for experts to say exactly where they'll land. But based on the average of their projections, a more predictable rate is likely below. So let me show you guys this chart. Okay, give me 1 second. Okay, so here's the chart right here. So for the first quarter, if you take Fannie Mae, Freddie Mac, MBA, NAR, if you average them, they're saying that the rate's going to be 6.35. Okay. And as you can see for fourth quarter, they're saying this it's going to be 5.73. Okay. Again, now this is all right. This is a prediction. So that means we'll start out the year about where we're at right now. Okay. But we could see rates tick down if inflation continues to drop. All right. Now, Greg McBridge, who's the CFA at Bankrate, he said mortgage rates could pull back meaningfully next year if inflation pressure eases. It's all about inflation. Okay. It's all about inflation. In the meantime, expect some volatility as rates will likely fluctuate in the weeks ahead. And if we see inflation come back under control, that would be good news for the housing market. So I'm gonna kind of sum this up, okay? Because they're all saying the same thing. It depends on what inflation does, okay? If inflation doesn't come under control, the Fed is going to continue to raise rates. If inflation comes under control, then it either be level, or if inflation comes down, then they may pull back a little. Okay, so we just got to kind of see. It's kind of a wait and see. I'm gonna show you guys what the housing price forecasts are. Okay, so Realtor.com says that they think we're going to see 5.4 increase. Okay, as you can see, NAR thinks is going to increase also. And these are people who think that housing prices are going to come down. Okay, Fannie Mae thinks housing prices are going to come down 1.5%. Now, this is truly real estate is local. Real estate is super local. So they're making a forecast overall. What do I think is going to happen? I think in Philadelphia, housing prices are going to stay stable, but tick up a little bit. We're not going to see the run up that we had the past year, the past 2 years, or 3 years, or 4 years. We're not going to see that. What we are going to see is activity fall off dramatically. And as a realtor, that's what I've been seeing. I've been seeing um, the listings that I have out there, the activity on those listings have fell off. Okay. Some are still selling. I just had a settlement Wednesday. So people are still buying and selling homes. Okay. People are still buying and selling homes. The only thing is that the activity is down. All right. So the bottom line is that in 2023, housing market is going to be defined by mortgage rates, and rates will be determined by what happens with inflation. So the best way to keep a pulse on what experts are projecting for the next year is to learn. Is to lean on a trusted real estate advisor as myself. All right. So let's connect. This is Colin Nathan Alim, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate, I got you. All right, y'all. Till the next time.